Momentum strategies continue to outperform the market, with our portfolio selection returning a whopping 8% this week while markets tumbled. In today's video, we'll review the success of this dual momentum strategy, why it's working in comparison to the indices. For those new to the channel, I'm an investor focused on momentum trading and technical analysis with a goal of identifying high-performing stocks and ETFs through a systematic trading strategy, resulting in outperforming the market on a consistent and long-term basis. If this is of interest to you, hit the subscribe button below. The portfolio that I'm sharing on this channel is a dual momentum strategy. I'm looking to create new content to help investors beat the market through momentum-based strategies, such as reviewing the research of momentum, explaining the details of momentum, why it works, and the caveats and pitfalls. Let me know in the comments below if you'd like to see more, and I'll look to get this new content up. For today's video, I want to go over the March portfolio selection I highlighted in last week's video. I'll leave a link to that below in the description. This dual momentum strategy first considers the overall market performance compared to cash and bonds before entering the market. If risk is on, the dual momentum strategy then selects from a universe of S&P 500 and NASDAQ 100 stocks, using a 90-day look back to rank the highest performers. The top 10 highest performers are then added or remain within the portfolio if they were selected last month. The portfolio is rebalanced on a monthly basis. In any instances of losses, I cut my losses when they reach a negative 10% and let the winners continue to grow. This calculated algorithmic momentum strategy removes my own mental bias and expands the universe of equities for selection. Over the past several months, this dual momentum algorithm has rightly seen the cooling of tech stocks and rotation into the energy and media sectors. In the video of the selection for last week, 60% of the selection was in the equity sector, 20% was in media, and 20% was in tech. I was hesitant of the two tech stock selection, given the cooling off that was already occurring. But as the point of a defined trading strategy is to follow it, I went forward knowing that this only represented 20% of the portfolio, and we had a 10% stop loss to reduce exposure if it got that low. As we look to the results today, we see that the overall market performance has been phenomenal for the week, with an 8% return driven by the 80% of the portfolio of energy and media stocks. In the top performers, we have Apache, Marathon Oil, and Diamondback. Still many other strong performers throughout, with Discovery Communications, Viacom, CBS, Occidental, and Devon Energy representing double-digit growth in only 5 days. HollyFrontier still showing great strength with a 4% return for the week. As considered, stop losses were entered for Baidu and Twitter, representing a 10% downturn for the week. Given this, we're still tracking at an 8% return for the month so far. Phenomenal, and as we dig into the other indexes, we'll see that this is all the better. Looking at the portfolio compared to the indices, we're clearly outperforming all of the measured indices, with a significant spread even compared to the universe selection of the NASDAQ 100 and S&P 500, outperforming each by 13% and 10% respectively. Let me know in the thoughts below on this portfolio what you'd like to see from the momentum trading strategy perspective and how we can continue to refine this momentum model to increase returns. Thanks.